Hi, I'm Lena, and welcome to Super Data JP, the channel where we turn Japan's real estate and cost of living numbers into answers you can actually use. Every video here is built on verified government data, not opinions and not guesses. Whether you're planning to invest, relocate, or just curious what life in Japan really costs, you're in the right place. Let's get into today's numbers.
Give your child 30 million yen while you're alive, and Japan can take over 10,355,000 yen of it in tax. Leave the exact same amount as an inheritance instead, and the tax bill can be zero. Same money, same recipient, completely different result, based entirely on which side of death it crosses on. Final video in our tax series, after resident tax and rental income tax. This time, what happens when money or property moves between generations? A question that matters to anyone with family, assets, or both connected to Japan. Japan taxes these as two entirely separate systems. Gift tax, Zoyozei, applies to transfers made while the giver is alive. Inheritance tax, Sozokuzei, applies to what's left behind at death. Both fall on the person receiving the money, not the one giving it. Gift tax resets every calendar year. Each recipient gets a 1,100,000 yen basic exclusion, and only the amount above that in a given year gets taxed at all. Above that exclusion, rates climb steeply and fast. Gifts from a parent or grandparent to an adult child or grandchild get a slightly better rate table than gifts between other people, but both tables reach a top marginal rate of 55%. Inheritance tax works completely differently. Instead of a flat per recipient exclusion, the whole estate gets one basic deduction, 30 million yen plus 6 million yen for every statutory heir. Then the remainder is taxed using rates that mirror the gift tax brackets. Concretely, a parent wants to move 30 million yen to their one adult child. 3 ways to do it, 3 completely different tax bills. Option 1, hand it over as a single lifetime gift. After the 1,100,000 yen exclusion, 28,900,000 yen gets taxed, landing a gift tax bill of 10,355,000 yen, about $63,920. Option 2, leave the exact same amount as an inheritance instead. With one statutory heir, the basic deduction alone covers 36 million yen, more than the whole transfer. Inheritance tax owed, 0 yen. Same person, same money, same relationship. The only difference is which side of death the transfer happened on, and that single fact is worth over 10 million yen here. This doesn't mean everyone should just wait and inherit instead of gifting, though. Gifts made shortly before death get pulled back into the taxable estate anyway, and Japan is currently in the middle of extending exactly how many years back that look-back reaches. Confirm the current figure for your specific situation with a tax professional before assuming any number here. The real planning tool isn't one giant gift or one inheritance, it's spreading gifts across many years, since that 1,100,000 yen exclusion renews annually per recipient. Small, repeated, early gifts can move far more wealth tax-free over a decade than either a lump sum or an estate ever could alone. There's a third option worth knowing, Sozokuji seisan kazei, a system that lets a parent or grandparent aged 60 plus gift to a child or grandchild aged 18 plus using a completely different set of rules. Elect into it, and you get a 25 million yen lifetime special deduction from that specific giver, on top of a separate annual 1,100,000 yen exclusion added in a 2024 reform. Anything beyond both gets taxed now at a flat 20%, then reconciled against inheritance tax when the giver eventually dies. Run our same 30 million yen case through this system, 780,000 yen, about $4,815, gets paid up front. But because this family's eventual inheritance tax works out to zero, that entire amount comes back as a refund when the estate is finally settled. One real catch, once you elect this system for a specific giver, it's irrevocable for every future gift from that same person. There's no switching back to the annual exclusion system for that relationship afterward. Now the part that matters most if you're not Japanese, or your family isn't. Both gift tax and inheritance tax liability depend heavily on where the giver and receiver actually live, not just their nationality, and getting this wrong can mean Japan taxing assets that were never physically in the country. Have a residence in Japan when you receive a gift or inheritance, and Japan generally taxes the entire worldwide value of what you received, property, bank accounts, and investments anywhere on Earth, not just what's sitting inside Japan. Move out of Japan, and that worldwide reach doesn't disappear immediately. Depending on your and the other party's residency history, Japan can still claim worldwide taxation if either of you had a Japanese residence within roughly the last 10 years, a look-back window extended specifically to close an earlier, shorter escape route. There's a specific carve-out for certain foreign nationals. Someone who has held a Japanese residence for 10 years or less within the preceding 15 years can be taxed on Japan-based assets only, worldwide assets excluded entirely, but this exception generally depends on your specific visa category. That distinction runs along Japan's visa table system. Holders of a Table 1 status, highly skilled professional, engineer/specialist in humanities, intracompany transferee, and similar, can potentially qualify for that exception. Holders of a Table 2 status, permanent resident, spouse of Japanese national, long-term resident, generally cannot. In practice, this means two foreign nationals with identical net worth and identical assets abroad can face completely different Japanese tax exposure on the same inherited fortune, purely because one holds a work visa and the other holds permanent residency or a spouse visa. One major relief worth knowing on the inheritance side: a surviving spouse pays no inheritance tax on whichever is larger, 160 million yen, or their full statutory share of the entire estate. The catch is that a return still has to be filed to actually claim it, even when the resulting tax is zero. The two taxes run on different clocks. Gift tax is filed February 1st through March 15th of the following year. Inheritance tax has to be filed within 10 months of learning the inheritance began, usually the date of death, a much tighter window for what's usually a far more complicated filing. And exactly like the non-resident landlord case from our last video, anyone without a Japanese address who owes either tax needs to appoint a Nozei tax administrator, to handle filing and correspondence from Japan on their behalf. This affects foreign nationals with Japanese family and assets in both countries, Japanese nationals who've built a life abroad but still have family or property back home, and anyone planning to eventually pass on Japan-connected wealth without knowing which side of the residency line they and their heirs actually fall on. Practical steps: map out your and your family's residency history before assuming which tax regime applies. Consider starting small annual gifts early rather than waiting for a single large transfer or an eventual inheritance. Get a professional opinion on whether sozokuji seisan kazei fits your specific family situation, and confirm a tax administrator arrangement well before it's actually needed. Across this whole tax series, resident tax, rental income tax, and now this, the pattern repeats. Japan's tax system rewards people who understand its timing rules, and quietly costs the people who don't. Gift tax and inheritance tax look like two versions of the same idea, but Japan treats them as fundamentally different systems with different exclusions, different rate structures, and completely different residency rules. The side of death your money crosses on can matter more than the amount itself. Quick recap: annual gift exclusion 1,100,000 yen. Inheritance basic deduction 30 million yen plus 6 million yen per heir, spousal relief up to 160 million yen, and in our model case, a 20% flat rate under Sozokuji seisan kazei. That's how the same amount of money can owe wildly different tax depending on how and when it moves. Subscribe for more data-driven breakdowns of life and investing in Japan.
And that's today's breakdown. If you're serious about real estate or moving to Japan, research like this is exactly what separates a smart decision from an expensive mistake. Subscribe so you don't miss the next deep dive, and drop a comment if there's a city or word you want us to cover next. Thanks for watching, and I'll see you in the next one.